Okay, so I'm going to discuss with the cost behavior and analysis of the cost, as well as what are the uses of this in this chapter. So what will be the learning objective of this topic? That first we will understand what is cost behavior and analyze and estimate what is cost, compute the contribution margin and also income. Now, types of cost behavior pattern. We know that we have two kind of cost. The first one is the variable and second one is the fixed cost. So in total, then if we say that variable cost, the total variable cost changes as activity level changes. So activity here means that number of clients, the number of units produced, right? If they are going to change, and on the basis of that, the variable cost will also change, right? So, but the per unit, if we talk about the variable cost per unit remains the same over a wide range of variety. Now, if we talk about the fixed cost, total fixed cost remains the same even when activity level change. So the activity level is changing 10 to 20, 100 to 200 customers. But if we talk about the fixed cost is the rent of the building. So rent of the building that will remain the same. For example, if employees are there, employees you are giving their salary, fixed salary. It means that also will remain the same. But fixed cost per unit goes down as activity level goes up. So this is that we have covered in the previous chapters. Now, just we have a very clear idea about what is the variable cost, what is fixed cost, and how these two costs are going to affect. So when these costs are going to affect, that is known as cost behavior pattern. Now look at this. If we talk about the variable cost example, on the left hand side, x-axis and y-axis that we have here, on the x-axis that we have the number of guests, on the y-axis that we have a total cost of meal, right? So in this case, as the number of guests increasing, definitely the meals are required. The breakfast, lunch, dinner, that will be required by increasing the number of guests, increasing the number of customer in some restaurant, for example. So what it means that the variable cost will increase in total. The variable cost that is going up in proportion to the activity. So here activity means number of guests that they are increasing from the 200 to 500. In proportion to that, you can see the 15,000, that is the total cost which has increased. If we talk about if it is the further increasing from the 500 to 700, you can see that 20,000, that is the total cost has increased around 20,000. So this is what this line says, that as the number of clients means number of activities increase, the total cost will also increase. But if we talk about the per unit cost in case of a variable cost example, so that will remain the same. As number of guests that increase, then you will see that the cost of the meal per guest will remain the same. This is the per unit cost is not going to change. So this is the example of a variable cost. Now, activity base. What is the meaning of activity base? A measure of event causing the increase of the variable cost. For example, if there is some activity going on, then on the basis of the activity, the variable cost is changed. And this is also called a cost driver. Unit produce is going to increase on the basis of the unit produced, means activity has increased, then the cost will be affected, cost behavior will be affected. Kilometers driven, a 1000 kilometer, 2000 kilometers, 5000 kilometers. If, for example, the Uber driver is driving on the daily basis, on the weekly basis, they're calculating everything on the monthly basis. So how many kilometers he has driven his car. On the basis of that, there will be some gas or fuel expenditure. On the basis of that, there will be some service charges. On the basis of that, there will be some additional cost, maybe the change of the tires. Right? Now, take an example of the labor hours and also machine hours. Machine hours are increasing. On the other side, that the cost will also increase. No doubt, production unit will also go up. Now, some of the examples of the variable cost we have. In the type of organization, merchandising company, manufacturing company, both merchandising and manufacturing companies. And the last one is service organizations. Now, the first one is merchandising company. The costs that are normally variable with respect to the volume of output. The cost of goods sold, right? So we have two factors. One is the revenue and second one is the cost. Means the sale price minus cost price is equal to the gross profit minus other operating expenditure. That will be the net profit before tax minus tax is equal to net profit after tax. This is normally that what we calculate. In merchandising company, it's not a manufacturing. So then cost of goods sold will be the base for that to calculating the cost. Right. In manufacturing company, we see the direct material and direct labor. Direct material, how much material that we have put in, that will consider as a variable cost. Right. So more materials, more will be the unit produced. And direct labors, so here some of the direct labors will be considered as maybe fixed or some may be considered as a variable, right? So direct labor may or may not be variable in practice. Variable portion of the manufacturing overhead as well. Now, direct material, direct labor, and overhead cost. So overhead cost that can be variable, indirect materials, lubricants, and supplies. That is a variable portion of the manufacturing overhead that we calculate. If the both merchandising and manufacturing company, then we have some selling, journal, and administrative cost. Commission, for example, clerical cost such as invoicing and shipping cost. So all these are some of the expenditures that we have under the variable cost. Service organization, supplies, travel, and clerical expenditures. Now, there are two kinds of cost: true variable versus a step variable cost. So true variable cost that directly we know that. So direct variable cost, direct material that we have. So true variable costs vary in direct proportion to changes in the level of activity. One unit increased, variable cost increase. But step variable, that is also will be increasing, but when the one step will be covered. We can take an example of this step variable cost. Let's say if in the gym there are 50 members, 50 clients are there. For the 50 clients, you need this much of place and you need a number of machineries. If the client is keep on increasing, then again that you will be keeping the same machinery and same place. But when it is going to like instead of 50, if you find that there are 20 more customer has come up or joined your gym, if there is a 20 slab, it means for next 20 clients you need one more machinery or you need to have more Machinery means you have to pay the more rent of the machinery. So no doubt this is a variable, but this will be against the step, against the level. Again, 20 more clients have come. Now that space, if the space is good enough, but again that one new machinery is required, right? It means for maintenance cost will also increase. So step by step. So that is known as step variable cost, that increase or decrease only in response to more than a unit change in the activity level. So now look at this. The true variable cost. The total long distance telephone bill is based on how many minutes you talk. So this is, we know direct means a true variable cost example. So you can see here that as the minutes talked increasing on the left hand side, you can see the total long distance telephone bills also increasing, right? Now, step variable cost. This is one example in front of you. Level of production, number of units per year. For example, if number of units per year is from 1 to 10,000, then the maintenance cost will be 7,000. If the number of unit production or level of production that increases from the 10,001 to the 20,000, it means that $14,000 that will be the maintenance cost. So there is the one level, one step from this range, from this point of time, and from this point of units. So if it is going beyond this, again that will maintenance cost will increase. If they are going to go to the next step, if you're then going to the next step, then the next step, right? So step by step, if that number of activities are going to increase or decrease, on the basis of that, then variable cost, for example, in this case, the maintenance cost will increase or decrease. So this is known as step variable cost. The gym example is the best one to make you understand. Now, look at this. Linearity assumption. Linearity assumptions and a relevant range. So there will be some relevant range. On the left hand side, you see the cost, and on the x-axis, you see the volume. A straight line is there that closely approximates a curve linear. Linear means the state variable cost. The state variable cost, the blue line, the state variable cost within the relevant range. Now you can see that from the point here, this point and this point, from this starting point to this ending point, and after that it's going to increase or decrease, and after before that's going to increase or decrease, right? That we are not taking into consideration now. What is the meaning of this? If in this case, if something is going to change something, right, then that is known as a relevant range. This is the relevant range. It means if we talk about the step variable, so we need to know that what is the relevant range over here. Now look at this. That was the variable cost we discussed. Now we are going to discuss with the fixed cost example. On the left hand side, y-axis, we have $5,000 as the cost of building rental. And the x-axis shows number of guests. If in a building, a renting building, if the number of guests means number of clients are increasing from the 250 to 1250, but the fixed cost means the rental of the building is not going to change. It's a fixed one. So fixed cost remain the constant in a total dollar amount through the wide range of activity. If activity range is going to change up or down or maximum or minimum, but a fixed cost is not going to change. But if we talk about the per unit fixed cost, definitely that will be going to change. If there are around 200 or 100, let's say this is the 100 range. So exactly we see here x-axis number of clients and number of guests they are coming in the, let's say, Airbnb. So 100. So if the 100 clients are coming here and the cost will be here 5,000. If the clients are increasing, then again the cost will be reduced. $20 per unit fixed cost renting a building. As the number of guests increasing, then here the cost per unit is going down. Per client, per guest, per customer will go down, right? So there is the variability here. Okay, now if we talk about the types of fixed costs, we have two fixed costs. The first fixed cost is committed, second discretionary. If we talk about the committed one, means the long term that cannot be reduced in short term. For example, depreciation, every year we charge depreciation. Depreciation is determined by the accounting standards, maybe uh, by the experts, maybe 10% or 20% or 30% on the different items. Building have a depreciation, land doesn't have a depreciation. We charge depreciation on the electronic item, we charge depreciation on the furniture and fixture, we charge depreciation on a car or a vehicle or a bike or a car or maybe a truck in the transportation company or maybe another company. So depreciation that we charge on the percentage basis, that will remain the fix. Okay, on the cost price of the assets, and also the depreciation on the equipment. Now on the right hand side, there's the discretionary. So discretionary means that it's depend upon the management, may be altered in the short term by current managerial decision. For example, that fixed cost they have decided that 10% of the sale, or maybe the $5,000 or maybe at $1,000 per month, that we wanted to spend on the advertisement, research and development. It's upon them, because this is the discretionary cost. They are saying this time we want 1,500 instead of 1,000, or the reverse going down $700, right? So as advertisement and R&D, research and development expenditure, it's upon them. So even then that will be considered as a fixed cost. Now, what is the trend towards the fixed cost? Increased automation, right? Increased automation. Then increase in salaried knowledge workers who are difficult to train and replace. Sometime we need to increase the salary of our employees who are trained, and there is a very difficulty to if to find the new client in the organization, to find the new worker, right? So replacement is a little difficult. So what you will do, a management will increase the salary from the 5,000 to maybe to the 7,000. They don't want that employee let go or leave the organization. So now what is the implication? Managers are more logged in with fewer decision alternatives, right? And planning become a more important and crucial because of fixed costs are difficult to change with the current operating decision. Now we talk about the labor cost, variable or fixed. It all depends upon the management flexibility and depends upon the employment terms and how employees are paid, maybe hourly or a fixed wage. If paid strictly on the basis of output, that definitely we say this is a variable. Take an example of this here. On the basis of output, if one client is going to produce 10 mobile covers, then he will be paid $2 per mobile cover. It means in a day, $20 will be given to him or her. If that employee is going to increase the output from the 10 to 100, 100 into $2 is a $200 will be given. If again further, if the efficient and experienced employee have a capacity to have output or produce 300 or 400 units in a day, so 400 into 2, the $800 will be given to him or her. So what is the meaning of this? It means even the labor cost may be variable or may be fixed. Second, if paid weekly or monthly or independent of the output, there is no any constraint. There is no any constraints about the output and number of units. No basis for that. Fixed salary. So they will be giving a fixed salary, or they may be giving, for example, $20 for 1 hour. Whether what is the output, they are not concerned about that, irrespective of the output or independent of the output. When the salary and wages are given to the employee is known as fixed fixed expenditure, fixed cost, fixed labor cost. Now look at this fixed cost and relevant range, part 1. Now office space is available at rental rate of 3,000 per year in increment of 1,000 square meter. As the business grow, more space is rented, increasing the total cost. So this is the example of a gym that I have given to you. It is just like that. So office space, no doubt, is available, and the client and owner is paying $30,000 every year. But if the more space is required, definitely it will be 1,000 square meter. They will have to have, means they will be increasing by not with the 500, but that will be 1,000 square meter. How I can elaborate it? For example, the one big room is there, a big hall, and there is a wall, and another big hall is also empty. If that you want to increase the space, there is a difficulty in increasing the space, unless that you break the wall or just to make some adjustments over there. And you cut the wall in such a way, make one door, maybe sliding, or another door, to have access to the another hall, so that another hall can be taken as a rental space by the owner, right, to accommodate more and more clients in the gym, right? So it means increment of 1,000 square meter. Now, so look at this. So that is the range known as relevant range. The total cost does not change for a wider range of activity, and then jump to the newer higher cost for the next higher range of activity is known as relevant range, right? So relevant range means 1,000 square meters. 1,000 square meter. If again, if space is required, so that will be 2,000 square meter. The cost will be increased at that particular time. But if it is 900, if it is a 700, right? So they are not going to change. But if it is a increment of 1,000, if there is a range specified, then if it is a 1,500 square feet, that is not possible. But it will have to be 2,000 square meters. Okay, so this is a relevant range that is set. Now, which of the following statements about the cost behavior are true? We have discussed about the cost behavior. Some of the statements, maybe one or two statements, or maybe three or four, may be true or false. I'm giving you 1 minute to think over it, and let me know Which statement is true? Your time starts now. So I can see some of the responses, right? So there can be, or there may be more than one option, right? So you can think very clearly about which statement is right means true, or which one is not true means false. Okay, fixed cost per unit vary with the level of activity. This is the one. Second, variable cost per unit are constant within the relevant range. Yes, this is also true within the relevant range, right? When the range increase, then it will change, but that remain constant. I think A and B is the right. Let's see the C and D as well. The total cost are constant with the relevant range. So if the relevant range is there, the total cost, total fixed cost, if the fixed cost is there $30,000, right, is you are paying for 1 year, and this is the fixed cost. But if the range, if it is the relevant range, they are not going to increase this one till there is a specific relevant range. So this is the C1. The D1 is the total variable cost are constant within the relevant range. Okay, so look at the answers now. So you will find A, B, and C are the correct answers. So A, B, and C. So three are the right? So the first and second and the third one, the fixed cost are constant within the relevant range. So within the relevant range, it will remain the constant. The why this is false. Total variable cost will remain the constant within the relevant. No, this is false. Rest three are right. Okay. Now fixed cost and relevant range. How do fixed cost is differ from the step variable cost? So step variable cost is also there. So step variable cost can be adjusted more quickly, and the width of the activity steps is much wider for the fixed cost. So what is the meaning of this? Look at this. We have here two kind of cost. So we find the two kind of cost here, the mixed cost, semi-variable cost. So mixed cost is also known as semi-variable cost. It means variable cost and fixed cost. The combination of these two is known as a semi-variable cost here. Look at this. The here that if you say this is the fixed part of the activity, the fixed cost, right? So fixed cost is here. And on the other side, you will from this particular point, and this is going to change. So that is the slope. Slope is going upward. So slope is going upward. So variable cost per unit of activity is increasing. As you can see that the number of rafting parties are increasing from here to here. The total fixed cost is this one, but if they are increasing If they are increasing, then definitely they will be going to charge some amount of money as a per unit cost. Units are increasing and this is also increasing, but this is the fixed one. Fixed cost plus variable cost is equal to fixed cost plus variable cost elements. Both we are having here. So that is the one cost is known as the mixed cost. So mixed cost is known as a semi-variable cost. Okay, so this is the one formula. So what you can do, you can write this formula right now on the paper. Check out the paper and you can write this formula there. You can write y is equal to a plus bx, or you can write this one here. The a is equal to, you can say, the fixed cost. You can write a or you can write f. It's upon you. So f is the fixed cost and you can write a as the fixed cost. This is the fixed one. A is the fixed one. So now we have bx. So bx, we can say the v. Vx, v is a variable. You can write vx or bx. It's upon you. That will be for your understanding. What is the f? F here is, f will be the fixed, right? Fixed cost, and v here is the variable cost, but depending upon the number of units. X will be the number of units, number of activities, number of hours, right? So the y is the total mixed cost. Total mixed cost. Y is the total mixed cost. A means f, right? The total fixed cost, right? Total fixed cost. Next, the B. Now this is the variable. The variable cost per unit of the activity. Per unit of the activity. And X is the level of the activity. So this is the formula that you should write on the paper right now, because the next part and some of the examples that we will be discussing on the basis of this. Now look at this. Mixed cost is equal to Y. Total mixed cost is equal to Y is equal to A plus BX. So this is that I have explained, right? So here this is the slope, variable cost per unit of activity, and this is the fixed cost activity. So both, this is the part A, this is A, and there will be BX. Okay, now if we talk about the analysis of the mixed cost, means semi-variable cost, the estimation of the fixed and the variable elements of mixed cost is dependent on the availability of historical data. It means the fixed and the variable elements of both these, known as like semi-variable or the mixed cost, this total estimation is depend on the data we have. The estimation of these two, that we will be able to get it for the next couple of years based upon the historical data. This is the one point, and this is true. Now we can see account analysis and engineering approach. There are different approaches to calculate the mixed cost. So here, account analysis and engineering approach, these are the two approaches are commonly used when there is little or no historical data available for analysis, right? So this will be a non-quantitative approach to the cost analysis. We want to analyze the cost, mean expenditure, but non-quantitative. We don't have that data. Okay, that will be totally based upon the estimation. Now, however, when the considerable amount of historical data is available, if we have some data and very good amount of data is available, then manager can choose the following three methods: high, low method, scattered graph, and regression analysis. There are three methods available to analyze the cost, to calculate the cost. So these are the quantitative approaches to the cost analysis. These are the quantitative: high, low, scattered, and regression analysis. So first two approaches is the qualitative, and the last one is the quantitative approaches. We have this analysis of a mixed cost, how we can do on the basis of all these five. Now, if we say that the manager who are unable to separate the variable cost from the fixed cost, if the total cost is there and manager, they are not in position or they are not able to separate how much is the variable cost and how much is the fixed cost, will not be able to make accurate prediction of the future cost. So if it will be very difficult for them to predict for the future cost if they are not able to make a separation of the total cost, what is variable and what is the fixed one. As I discussed, account analysis and engineering approach. Account analysis is each account is classified as either variable or fixed based upon the analyst, means that researcher knowledge of how the account behave. It's all upon them. Engineering approach, the cost estimate are based upon the valuation of the production method and material, labor, and overhead requirements. Now we have some data. So some mixed cost and activity level data is available in front of us for 1 year. From January to December, we have some activity volume. For example, in the hospital, there are patient days. In 1 day, let's say in January, these are the number of patients, for example, and the cost. This is the maintenance cost for maintaining all these patients. This is the cost. So we have these number of units, activities, and here we have maintenance cost. As we can see, which is the highest one? If we talk about here, the total volume highest is around, you can say, 8,000. Above 8,000, I cannot find anything. And here is 9,800, and this is the highest. And here, if 8,000 is the highest, and what is the lowest one? 56. I think 56. And here the lowest one is 7,450. Okay, so highest and lowest in both these that we will calculate because we have some historical data. So let's see what happened. We know that 8,000 patients, this is the high, and the low is 5,000. And maintenance cost is 9,800 is the high, and the low is 7,450. Here on the y-axis and x-axis, so we have this information, cost and patients respectively. And if this is the fixed cost, that we know 3,536 is the fixed cost, and we have this line from here to here, that is the variable. The total is the mixed cost or semi-variable cost, right? So now look at this. Select the highest level and lowest level of activity and related total mixed cost. So now we have these, the activities and related mixed cost. It means in this cost, one variable and fixed both are combined. Variable and fixed both cost are combined. Now the manager should have ability to separate this cost into two. How much is the variable and how much is the fixed cost? This is the today's main topic. Now, using these two level of activity, we can calculate the total variable cost per unit we can calculate. Total fixed cost, we can calculate, and then express the cost in equation form, that y is equal to a in fixed cost plus b is a variable cost per unit, and x is the level of activities. Now look at this. We have some units and we have some cost. So units are available, costs are available, and how much is the difference between the highest and lowest is the 3000 and a 2350. Now you have calculator with you, right? So now what you can do, cost divided by number of units. So unit variable cost will be calculated. 2350 then divide by 3000. Now unit cost, unit variable cost. So when we are going to change this one, unit variable cost will be calculated. Let's see. So this is the unit cost, unit variable cost. So this is the amount and this is the number of unit. This is the 0.783 is the per unit cost. Now, next, what we have here. The second is we want to calculate the fixed cost. So fixed cost for this one, the total cost is, we know that y, right? This is the total cost. Total cost. So total cost minus variable cost will be the fixed cost. Very simple. From the total cost, if we are going to subtract the variable cost, because we have calculated variable cost per unit 0.783 multiplied by 8000. This is a 6264 and is equal to 3536 is the fixed cost. Go back 3536 is the fixed cost. Okay, so in this way that we have calculated the fixed cost. Now next we have the third one, total cost. We will put everything in the formula. We know the fixed cost, we calculated 3560, we put it here. The fixed cost means A, or you can say F, plus B is what? So B is 0.783, that is the B, and X as it is, we have written X, and that's it, and Y that we have written Y. This is what we have done. So this is that was required, and we have implemented exactly the same thing. Now, with the help of this formula, we will be able to differentiate the total cost very easily. Now, if let's say the sales, salaries and commissions are 10,000 when 80,000 units are sold, and if 14,000 when 120 units are sold, what is the variable portion of the sales, salary and commission? Now you need to calculate this one. I'm giving you 1 minute for this. It's very easy steps. We know the highest, lowest method for calculating the variable and fixed cost. So with the help of that, then we will be able to calculate, variable cost per unit. Variable cost per unit. Okay, so here is the answer, 0.110 per unit, 10 cent per unit. So what we did, highest minus lowest, and the 4,000 divided by 40,000 units, 0.10 per unit. This is the right answer. Now, if the sales salary and commission are 10,000 and 80,000 units are sold, and 14,000 and 120 units are sold, what is the fixed portion of the sales salary? Now, everything is available. We need to find what is the fixed cost. Now it's upon you how to calculate the fixed cost for you. Okay. Okay, so we know that with the help of the formula, the y is equal to f plus vx. So we will be able to calculate the fixed portion of sales and commission. So in this, we should know what is the total cost. We know the total cost here is, let's take an example of 10,000 is the total cost, or 14,000 is the total cost. So the 10,000 is the total minus variable cost is 80,000 multiplied by 0.10. 8,000, then fixed cost will be 2,000 here. So you can see the answer right now here. So total cost is the total fixed cost. Total fixed cost, let's say 14,000 minus the number of unit here is 120,000 multiplied by 0.10 is 12,000 is equal to 2,000. Now take another example. If it's a 10,000, right? So total cost is 10,000. Let's say this is the 10,000. Total cost is 10,000, and we have produced 80,000 units. So 10,000, 80,000 into 0.10 is equal to 8,000. So 10,000 minus 8,000 is equal to 2,000 again. So it means 2,000 always will be the fixed cost, irrespective of that the production level change, unit level change. Fixed cost will remain the fixed. So this is the way to calculate. Okay, so now we have here quick check using the high-low method. Mean estimate the cost formula y is equal to a plus bx for the patient admitting cost on the previous page. So we have here, let's say y total cost, we have this much, we have this much, we have this much, and we have this different criteria is given to us. Now let's take a look at the B1. Let's say A is equal to 9720 plus 2. This is the fixed cost. This is what? This is the fixed cost that we have, right? And this is the 2 is the variable. For example, 15,060 minus 14,068. But this is, for example, this is given. This is the highest cost minus the lowest cost, 380. Highest units, lowest units, 190. 2 is the variable. 2 is the variable cost per unit. Okay. Now, if we have this 2 is the variable cost per unit. The 2 x here. So x is what? We need to find x. So x. So 2, this is given. 2 is given. X, for example, that if we take this one, 2670 here, and the cost, we will take this one. Cost means total cost minus variable cost is equal to, this is the fixed cost we have. So total cost minus variable cost is equal to fixed cost, 9720. Exactly the same thing you can find it here. This is just we are verifying on the basis of the data given. Okay, now we have another method as well. Scattered graph methods. High-low method is there, but scattered graph method is also available. That is used for the quantitative methods. Now, scatter graph method. This is considered the more accurate method of analyzing the mixed cost, means semi-variable cost. The scatter graph method takes into account all of the activity volume and cost data. So all of the activity volume and cost data that we are reflecting here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So all the cost that we have calculated, for example, and we are writing here. This is for activity increasing, and this is the cost. Activity increasing, this is the cost. Activity again increased, this is the cost. We have made the some points. So after then, once that we have make these dots, we will plot one line. So line should be between all these. Some 1, 2, 3, 4, 1, 2, 3, 4, 5, like this. So this and this, we can make a straight line here. But that will be the cost here. The lower part will be the fixed one, and upper will be the variable one. Let's see. This is also one way of calculating. So now just I have drawn this line. So draw a line through the data points with about an equal number of points above and below the line. Equal number of points. 1, 2, 3, 4, and 1, 2, 3, 4. And here this one and this one that we are touching and covering with this straight line, linear line. So that is a scattered graph method of calculating the cost. So in this way, we will be able to calculate like this is the fixed cost. This is the fixed cost here, right? And this is the variable cost that we will calculate. So estimated fixed cost is the $10,000 here in this change. The slope of this line is the variable unit cost slope is a change in the total cost for the one unit, and change in the activity. Cost is increasing, activity is increasing, like this. So this is one part. This is the variable, this is the fixed one. Now, if we talk about the slope, how much is the slope? Change in the cost, change in the unit. So now here that you will going to write the change in the cost. So cost is going to change from here to here, here to here, here to here, here to here. Changing in the cost, and changing in the cost here, and changing in the activity, means number of units. That will be the slope. That will be the slope that you can have here. This is the slope. So we have here horizontal distance in the changing of activity. From here, if you make a dotted line here, and this is the vertical distance, and this is the horizontal distance in the change, is the change in activity, horizontal and vertical. Okay, so same thing that we can see here, exactly the same thing. So scattered. However, rather than just fitting the line to the graph, to the high and low point, all points are considered when line is drawn. All points are considered when line is drawn. So here that we are also considering the upper one, lower one. So in this case that we have this one. So from here to here is the relevant range. So what is the relevant range? This point, you can see this point, the blue one, and here this point, the blue one. From this point to this point, the cost is increasing up and down, up and down, up and down with the activities. So this is the relevant range. We can say from here to here. This is the relevant range. Fixed cost and variable cost per patient we have calculated. This is a scattered graph method. Now, next method we have the least square regression method. This method uses the mathematical formula to fit the regression line. The method also takes all the data into account when estimating the total cost formula. Software can be used to fit the regression line through the data point. Okay, and the total analysis objective is the same. So main objective that will remain the same, the formula is the same. So computer software can be used to find this one, that a least square regression method. So least square regression method also provide a statistic called adjusted R square, regression square, that is measure of the goodness of a fit of regression line to the data point. Look at this. So we have this information, least square regression, just like the scattered one, the activity and the cost you can find. So R square for the relationship is near 100% since the data points are very close to the regression line. So if the data is very close to the regression line, they are very close to the regression. This is the regression line, right? So data is very close to this one, right? Since the data is very close to this one, then we can use this least square regression method to establish and see the relationship. Now look at this. In the regression line, we can see some of the points are here, that from one point, all these are near points. All these are the near points. So this is the regression line, you can see regression line. Now we're going to compare the three methods. The high-low method is very easy to understand and apply. And if you talk about the limitation, it utilizes only the 2 points in the analysis, and these could be abnormal observation. The cost formula may seriously misrepresent, and the two cost relationship that holds during the normal period. So some of the limitations you can find it here, but it's very simple. Scatter graphics, it can be extremely useful tool in the hands of the experienced analyst, and COX is cost behavior due to strikes, bad weather, or a breakdown, or so on, and become immediately apparent to the trained observer, right? So some cost may increase or decrease due to some bad weather condition or something like that, right? But on the basis of this, even then, that we will be using this scattered graph dots, and after then we will be drawing one line. So the limitation is the line draw is a subjective. Yeah, it's a subjective. If we can draw line up or down, right? No two analysts. One analyst is Mr. A and Mr. B. Mr. A is analyzing in a different line, B and B is analyzing in a different line. That may be the limitation. At least square regression. It is an objective and precise approach. It uses all the data point and analysis. It mathematically fits the regression line. It proves other useful statistic, and analysis can be done using computer software. So computer software can be used for this. But for now, for our understanding, that high-low cost will be used for practical purpose. The contribution formula. Now, next is the contribution formula or format. This is important to use the separate or separation of the cost into fixed and variable. Is that manager can be used use the information to compute the contribution margin. Okay, what is the contribution margin? Contribution margin is amount remaining once all the variable costs have been deducted from the sale. Sale minus variable is equal to contribution margin. I am repeating once again. Sale. Total sale in the gym, $20,000. Sale. Variable cost. Customer are increasing, machines are increasing. Customer are increasing, some other costs are increasing. Means variable cost. Now, this one minus variable cost is the contribution margin. From the contribution margin, you will reduce the $5,000 as a fixed monthly rent. The rest of the amount will be the profit. Okay, so the contribution margin is total sale minus variable cost. Total sale minus variable cost. So it provides manager with an income statement that clearly distinguish between the fixed and variable cost. So great for planning and decision making. Contribution. Let's say, for example, $100,000 minus variable cost is the 40,000 is the contribution margin. Fixed cost 30,000 and net income is this much. So this is contribution margin. 40,000 is the contribution margin. If the contribution margin is available, net income is available, we can calculate the fixed cost. This minus this is equal to fixed cost. Very simple. Look at this. Traditional format and contribution format. Traditional format was a sale is given, cost of goods sold is given, gross profit minus all the expenses is equal to net profit, net operating income. Now here contribution format, sale is there 12,000, variable cost, cost of goods sold, variable and variable selling and variable administration, all the variables 7,000, and contribution margin is 5,000 minus fixed, that is the net operating income. This format is used for external reporting and this format is used for the management. So this is the conclusion that you can see. A firm understanding of the cost behavior is important for planning, decision making and reporting, and the variable costs change in the proportion with the change in activity, where the total fixed costs stay constant within the relevant range of activity. Total mixed cost Y can be expressed as the Y is equal to A plus BX, whereas represents the fixed cost and B is the variable cost per unit and X is the activity level. The cost equation can be determined through the use of high-low methods, scattered methods, or the least square regression method. Contribution margin is the total of the sale minus, you can say sale minus variable, right? So sale minus variable. From the variable, then we will subtract the fixed one. That will be the operating income. Contribution margin. So contribution margin income statement is separate cost by behavior.